Have you ever thought about investing in the stock market, but perhaps you're not sure where to start, or the entire process seems too complex or intimidating? Well, fear not. Today, we're going to simplify things for you. We're going to break down the process of investing in the stock market into digestible, easy-to-understand steps. We'll introduce you to the stock market as a viable and often rewarding investment option. By the end of this video, you will have a basic understanding of how to start investing in the stock market. You might be wondering, why should you invest in the stock market? Is it worth the risk? Well, let's dive into this a bit. First off, the stock market offers the potential for high returns. Yes, you heard that right, high returns. Unlike your traditional savings account, which offers a meager interest rate, the stock market has the potential to boost your wealth significantly over time, thanks to the magic of compound interest. Now let's talk about dividends. Investing in the stock market can provide you with a steady stream of income through dividends, which are a portion of a company's profits distributed to shareholders. Imagine this as your money working hard for you while you sit back and relax. Moreover, the stock market allows for diversification. By investing in a variety of stocks, you can spread your risk across different sectors, companies, and regions, lessening the impact if one investment performs poorly. And let's not forget about ownership. When you buy a share of a company, you become a part owner of that business. It's like having a slice of the corporate pie without having to run the day-to-day operations. But it's not all roses. Investing in the stock market also comes with risks. Market volatility can lead to potential losses, and there's always the chance that a company could underperform or even go bankrupt. Remember, every investment comes with its own set of risks and rewards. It's all about finding the right balance for your financial goals. So, you've decided to take the plunge. But how do you start investing in the stock market? Let's begin with setting financial goals. Are you investing for the long haul, perhaps for retirement or a child's college fund? Or are you looking to make a quick return? Your goals will guide your investment strategy, so it's crucial to define them from the get-go. Next, understand your risk tolerance. This is the degree of variability in investment returns that you can withstand. If you're prone to panic when your investments take a slight dip, you might want to stick with safer stocks. On the other hand, if you're comfortable with taking risks for potentially higher returns, you might consider more volatile stocks. Now it's time to research. The stock market isn't a guessing game. It's about making informed decisions. Look into the company's financial health, its competitive position, and the market trends. Assess the stock's price-to-earnings ratio, its dividend yield, and other key metrics. There's no shortcut here, folks. You've got to do your homework. Once you've done your research, you can start building your portfolio. But remember, don't put all your eggs in one basket. Diversification is key. Spread your investments across different sectors and companies. This way, even if one stock doesn't perform well, others might, balancing out your overall returns. Lastly, remember to monitor your portfolio regularly. The stock market is always changing, and so should your investment strategy. Rebalance your portfolio periodically to ensure it aligns with your financial goals and risk tolerance. But here's a word of caution. Don't get carried away by market fluctuations. Investing is a long-term game. It's not about timing the market, but time in the market. Don't let short-term losses deter you. Stick to your plan and stay the course. Investing in the stock market is not a sprint, it's a marathon. It requires patience, discipline, and a well-thought-out strategy. Investing can seem stressful, but it doesn't have to be. How can you make investing a less stressful experience? Let's explore some tips to help you ease into the world of investing without the added worry. First, start small. It's perfectly okay to begin your investing journey with a modest amount of money. This allows you to get a feel for the market's ebbs and flows without risking a significant portion of your hard-earned cash. As you become more comfortable and knowledgeable, you can gradually increase your investment. Second, invest only what you can afford to lose. This is a golden rule of investing. Remember, the stock market is not a guaranteed money-making machine. It's always possible to lose money, so never invest funds that you'll need for immediate or essential expenses. Next, avoid the herd mentality. Just because everyone else is rushing to invest in a particular stock doesn't mean you should too. Make your investment decisions it based on careful research and analysis, rather than getting swept up in what everyone else is doing. Similarly, don't be swayed by market rumors. It's easy to get caught up in the latest buzz, but basing your investment decisions on hearsay can lead to unnecessary stress and potential financial loss. Always verify information from reliable sources before making any investment decisions. And lastly, focus on long-term goals. Short-term market fluctuations can be nerve-wracking, but remember that investing is a marathon, not a sprint. Keep your eyes on your long-term financial goals and don't let temporary market downturns derail your investing strategy. Above all, remember that investing isn't about getting rich quick. It's about steadily growing your wealth over time to achieve your financial goals. So, take a deep breath, stay patient, and keep learning. The more you know, the more confident and less stressed you'll be. Investing should be a means to achieve your financial goals, not a source of constant worry. Keep these tips in mind to make your investing journey a smooth one. Investing in the stock market can be tricky and it's easy to make mistakes, but what are some common pitfalls you should avoid? Let's dive right in. First up, we have the classic blunder: investing without a plan. Picture this: you're on a road trip without a map or GPS. Sure, you might stumble upon some scenic routes, but you're more likely to get lost. Similarly, investing without a clear plan or strategy is like navigating unfamiliar terrain without a guide. It's crucial to have clear financial goals, a defined timeline, and a well-thought-out investment strategy to steer your journey. Next, there's the temptation to put all your eggs in one basket, or in this case, all your money in one stock. This is a risky move. If that one company tanks, so does your entire investment. Diversification, spreading your investments across a range of different assets, is a key strategy to mitigate this risk. It's like having a variety of food on your plate to ensure a balanced diet. Then there's investing based on emotions. The stock market, much like life, has its ups and downs. It's easy to get caught up in the thrill of a rising stock or the panic of a falling one. But making investment decisions based on emotional reactions often leads to poor choices. It's essential to keep a cool head and stick to your plan, even when the market gets turbulent. Lastly, neglecting to regularly review the portfolio is another common mistake. The market is ever-changing, and so are our lives. Maybe you got a new job with a higher salary, or maybe a company you've invested in has taken a downturn. Regularly reviewing your portfolio ensures it remains aligned with your goals and responsive to any changes. Think of it as a regular health checkup, but for your investments. Avoiding these common mistakes can save you from potential losses and help you stay on track with your investment goals. So remember, plan your journey, diversify your portfolio, keep emotions in check, and regularly review your investments. Happy investing! Now that you have a basic understanding of investing in the stock market, it's time to recap what we've discussed today. We started by exploring why investing in the stock market is beneficial. We learned that it can be a powerful tool for wealth creation, providing an opportunity to grow your money over time. Through compounding, even small investments can balloon into substantial sums. But we also acknowledge that the stock market isn't a guaranteed goldmine. It comes with its share of risks and volatility, and it's not uncommon for investors to face losses. We then dove into how to start investing in the stock market. We highlighted the importance of setting clear financial goals, doing your research, and diversifying your portfolio. We stressed that investing isn't about getting rich quick, but rather about making calculated decisions based on research and strategic planning. Following this, we offered some tips for stress-free investing. We talked about the significance of maintaining a long-term perspective, staying calm during market downturns, and not letting emotions dictate your investment decisions. We also underscored the value of regular investing, which can help mitigate the effects of market volatility and average out the purchase cost of your investments over time. Next, we delved into some common mistakes to avoid. We warned against putting all your eggs in one basket, chasing hot stocks without doing your homework, and making impulsive decisions based on market rumors or panic. We emphasized that investing should be approached with a cool head and a clear strategy. Throughout our discussion, we've reiterated that investing in the stock market is not a sprint but a marathon. It requires patience, resilience, and a willingness to learn from mistakes. Remember, investing is a journey, It may seem daunting at first, but with research, careful planning, and patience, you can make the stock market work for you.